Hello to you all at Credit Suisse. In this video, I will start with presenting a macro view of the container shipping industry, followed by an overview of the Danish conglomerate AP Moller-Maersk, and finally, I'll be presenting my advice to the board of directors over at Maersk on their future positioning. Starting with the global container shipping industry, the world's largest export region is dominated by Asia, followed by Europe, North America, and the Middle East. It is no surprise to then note that the world's largest container port terminals are present in the Asia-Pacific region of the world, handling the most TEU capacity. Since the turn of the century, the global demand growth of container shipping has averaged mid-single digits annualized, with evident slowdown during the financial crisis. However, current demand growth rates are at their lowest levels since then. On the other hand, over the past 4 years, the shipping container supply growth has steadily increased, with a record number of ship orders being placed by dominant players in the shipping industry. The reason behind such orders mainly reside in the forecasted future growth of container demand by the operators, as well as the attraction of fuel efficiencies associated with the new larger capacity ships. The supply of TEU capacity has remained above demand for some time in the industry. However, excess supply growth of TEU capacity is likely to continue going into the future, remaining above demand as forecasted by McKinsey. The result has created an imbalance of supply and demand within the sector, and overcapacity is impacting freight rates, which emanates to lower profitability for many container operators, with several not even covering the cost per container transported, as well as some entities taking their fleet off market. Now, looking into the future, the key trends covering the industry will be continued overcapacity as a result of shipping capacity exceeding demand, with continued larger ships coming onto the market over the next few years as orders are fulfilled. Freight rates are likely to remain stable for both 20 and 40 feet equivalent units. The fall in the oil price will benefit the unhedged container shippers, reducing operating costs. Recent action by the People's Bank of China to cut interest rates and devalue the yuan is likely to benefit the shippers exporting trade out of China. The continued European Central Bank stimulus is likely to benefit earning results of key European container shippers, benefiting from favourable foreign exchange movements against the euro. Moving on to the conglomerate, AP Moller-Maersk as the world's largest shipping operator, based in Denmark and listed on the Copenhagen Stock Exchange, the group has a market cap of around $31.8 billion US, with revenues equating to $47.3 billion for the latest financial year. The Maersk Group is made up of 5 distinct operating units, starting with Maersk Line as the world's largest container shipping operator with over 600 ships, Maersk Oil operating within upstream exploration and production of oil and gas, APM Terminals overlooking 64 terminal ports around the world, Maersk Drilling facilitating upstream exploration companies through various drilling facilities, and APM Shipping Services, made up of several entities relating to the transportation and logistics of trade. The majority of Maersk Group's sales are accounted for by Maersk Line at around 58%. Revenue growth has remained flat for Maersk Group for the past 2 fiscal years at $47 billion. Over the same period, the net income has grown by 45% from $3.4 to $5 billion. The net income increase for the group is a result of the reduction in costs, bringing to fruition the cost-cutting strategy implemented by management. Maersk Line faces intense competition from industry rivals gaining market share. To synergize its position, in early 2015, Maersk Line formed a strategic alliance with the world's second largest container shipping giant, the Mediterranean Shipping Company. The alliance, known as 2M, will facilitate a joint vessel sharing agreement across routes from Asia to Europe, the Trans-Pacific and the Transatlantic region. According to the relative wealth chart, CFROI has remained below the cost of capital for the past 5 years. Shareholder value is being destroyed by management. Sales growth has declined with negative growth over the past 2 years. Asset turns are declining, equating from the negative impact on asset efficiency. The operating margins have increased over the last 3 years, mainly benefiting from cost-cutting measures implemented by management. Finally, my advice to the board going forward: firstly, to focus on investing in operating units that are creating shareholder value for the group, divest from assets such as Maersk Tankers, Maersk Drilling and Maersk Oil that have destroyed shareholder value consistently and require significant capital investment over the coming years, which is likely to further impact ROIC negatively for the group. Cash from divestments can be used to pay down debt, improving the group's credit rating and reducing the group's leverage ratio. Continuing cost reductions are of great importance in maintaining profitability in an environment where the freight rates are stable or facing headwinds. The overall group should focus its abilities on the container shipping industry, holding complementary assets, synergizing the group's returns, and helping its position as the #1 container shipping operator in the world.